Unraveling negative yield bonds. Why would investors embrace them? In the realm of fixed income investments, it may seem counterintuitive that some bonds offer negative yields, meaning investors receive less than their initial investment when the bonds mature. Despite this apparent peculiarity, negative yield bonds serve distinct purposes in the financial landscape. In this article, we delve into why these bonds exist and why investors might consider using them. Understanding negative yield bonds. Negative yield bonds, also known as negative yielding bonds, or bonds with a negative yield, are debt securities that, at the time of purchase, are expected to yield a return less than their principal when they reach maturity. This means that if you buy a negative yield bond and hold it until maturity, you will receive less money than you invested. Why negative yield bonds exist? Several factors contribute to the existence of negative yield bonds. Central bank policies. Negative yields can be driven by central bank policies. When central banks implement negative interest rates to stimulate economic growth, it can result in a domino effect, pushing yields on government bonds into negative territory. Investor demand. In times of uncertainty and market volatility, investors often seek the safety of government bonds. High demand for these bonds can drive up their prices, leading to lower yields, including negative yields. Market sentiment. Geopolitical concerns, economic uncertainty, and risk aversion can lead investors to accept negative yields as the price for capital preservation and a safe haven for their investments. Currency appreciation. In some cases, investors are willing to accept negative yields in the expectation that the appreciation of the underlying currency will offset the loss in yield. Why investors use negative yield bonds? Surprisingly, there are situations in which investors willingly embrace negative yield bonds. Portfolio diversification. Investors may include negative yield bonds to diversify their portfolio, especially when seeking to mitigate risk and preserve capital in uncertain times. Risk mitigation. Negative yield bonds are often considered a safe haven asset. Investors are willing to pay a premium for the security and stability they provide, even if it means accepting a negative yield. Currency play. When investors anticipate currency appreciation, they may buy bonds in a foreign currency with negative yields, hoping that the currency's value will increase more than enough to offset the loss in yield. Hedging strategies. Negative yield bonds can be used as part of sophisticated hedging strategies, such as those used by institutional investors and multinational corporations to manage currency and interest rate risks. Monetary policy impact. Investors might accept negative yields as a response to central bank monetary policies, expecting these policies to stimulate economic growth and potentially lead to capital gains in the bond market. Conclusion. In conclusion, the existence of negative yield bonds may seem perplexing, but they play a vital role in the financial landscape. Investors turn to them for safety, risk mitigation, and portfolio diversification, particularly in times of economic uncertainty and when seeking to capitalize on currency trends. While accepting negative yields may appear counterintuitive, it's a calculated decision based on a variety of financial and economic considerations.